Something shifted in Tokyo last week. Not loudly. Not with the kind of spectacle that gets wall-to-wall coverage. A political election handed one woman an extraordinary degree of power, a two-thirds supermajority in the Japanese parliament. And while most coverage focused on the symbolism of it, on the nationalist rhetoric, on the diplomatic signals toward Beijing, the part of the financial world that actually moves capital was looking somewhere else entirely. They were watching the bond market, and what they saw there tells a very different story than anything you heard on television. Japanese interest rates spiked immediately after the results came in. The 10-year government bond yield climbed to levels Japan hadn't seen since 1999. More than 25 years of suppressed rates, zero rates, negative rates, yield curve control, the entire architecture of cheap Japanese money. And now, in the wake of one election, the number moved in a direction that matters more than almost anyone publicly admitted. This isn't a headline. It's a structural signal. And if you own any meaningful position in U.S. equities, which if you have a 401k, a brokerage account, or virtually any retirement product, you almost certainly do, then this signal belongs in your awareness right now. Let's start with who she is, because the policy matters before the mechanics. The new prime minister ran on a platform of aggressive domestic stimulus, tax cuts, suspension of the consumption tax on food, more government spending, more money put directly into the hands of Japanese households, and she won decisively, not narrowly, not under political constraint, but with the kind of legislative margin that actually lets you move quickly. A supermajority is not just a victory, it's acceleration. Leaders with that kind of mandate don't wait for the next election cycle to build consensus. They move. Fast. And markets, which price in the future, had already begun processing what that movement would cost. Here's the core problem. Japan's debt is already among the highest of any developed nation on Earth, measured against the size of its economy. When a government with that kind of structural debt load promises aggressive new spending without a credible source of funding, bond markets don't accept the promise at face value. They price in risk. They demand higher yields to compensate for the uncertainty of repayment. And that's exactly what happened. The yield moved, not catastrophically. Not in a way that broke headlines globally, but enough to matter to everyone who understood what was underneath it. What's underneath it is something most retail investors have never had explained to them in plain terms. The carry trade. For decades, long enough that an entire generation of professional investors treats it as background assumption rather than active risk, Japan has functioned as the world's cheapest source of borrowed capital. The mechanics are straightforward. When a country holds its short-term interest rates near zero, or even below zero, borrowing in that currency costs almost nothing. So institutions, hedge funds, proprietary desks, large asset managers, borrow in yen at negligible rates, convert those yen into dollars, and deploy the dollars into U.S. assets. Treasury bonds, credit instruments, equities, anything that generates a return. The difference between the near-zero borrowing cost and the return on the U.S. asset is pure profit. Scale it with leverage, repeat it across hundreds of billions of dollars worth of positions, and you have the global carry trade. It's not exotic, it's not hidden. It's been the structural plumbing of global capital markets for most of the 21st century. And its size is enormous, because when something reliably generates free money over a long period, no one does it modestly. They do it at scale. They do it with leverage. They treat it eventually as something close to a law of nature. It isn't. When Japanese rates rise, even slightly, even without drama, the economics of that trade change. The funding is no longer nearly free. The spread compresses, and if the yen also strengthens while dollar-denominated assets are under pressure, the trade doesn't just become less profitable. It can go negative. Quickly. And that's when something mechanical happens. Unwinding a carry trade is not a passive event. It's not a philosophical decision to reassess strategy. It's a forced series of transactions. To close the position, you must buy back yen, which drives yen higher. And to raise the capital to buy back yen, you must sell the assets you bought with the original loan, which means selling U.S. Treasury bonds, selling U.S. equities, selling credit instruments, all of it, at whatever the market will bear, under time pressure, often simultaneously with everyone else who is running the same trade and seeing the same signals. This is how a political election in Tokyo becomes a down 3% day in the Nasdaq without any obvious American catalyst. Not because Japan directly controls U.S. markets, because the leverage structure connecting them is invisible until it isn't. We have already seen smaller versions of this. In August 2024, a relatively modest shift in Bank of Japan policy expectations triggered an abrupt global equity sell-off that surprised commentators who weren't tracking yen dynamics. It was sharp, it was fast, and it reversed, but not before exposing how quickly the mechanism can activate. The question now isn't whether the mechanism exists. It's how much pressure has been building inside it. And here is where the numbers start to get serious. Japan holds approximately $1.4 trillion in foreign exchange reserves. The majority of that sits in U.S. dollar-denominated assets, principally U.S. Treasury bonds. That reserve pool wasn't accumulated by accident. It was built over decades as a direct byproduct of Japan's export-driven economic model. Sell goods priced in yen, accumulate the dollar proceeds, recycle them into treasury bonds to manage the exchange rate, and keep yen from appreciating too fast. It's a feedback loop that served both countries reasonably well for a long time. What changes now is the policy context around that reserve pool. A new government with a strong mandate and domestic spending obligations will face funding pressures. And when governments face funding pressures, they look at what they have. Japan has $1.4 trillion in foreign assets. Those assets can be sold. Those proceeds can be repatriated. And if even a meaningful fraction of that reserve pool were liquidated in a compressed time frame, the U.S. Treasury market, which relies on foreign demand to absorb its constant issuance, would feel it. Pause on that for a moment, because this is where the story stops being about Japan. The United States currently carries a national debt load that requires continuous, massive issuance of new Treasury bonds. Every month, the Treasury auctions new debt to replace old debt and fund ongoing deficits. The demand side of those auctions includes foreign central banks and sovereign wealth funds as a critical component. When that foreign demand weakens, when buyers step back, or worse, when they become sellers, yields rise. Rising yields mean the U.S. government pays more to service its debt. More debt service means more pressure on the budget. More pressure on the budget means more borrowing. More borrowing means more treasury issuance. More issuance into a market with weakening foreign demand means higher yields still. It's not a loop with a natural stopping point. Higher U.S. yields also directly compress equity valuations. The math is not complicated. When the risk-free rate rises, every other asset class is repriced against it. Growth stocks, which are valued on earnings projected years into the future, are most sensitive to this dynamic. Their valuations compress the most when discount rates increase. But the pressure doesn't stop at equities. It flows through to mortgage rates, to corporate borrowing costs, to the financing conditions of every leveraged entity in the economy. And the leverage in this system is extraordinary. The carry trade alone represents hundreds of billions in positions connected to Japanese funding costs. The U.S. Treasury market is the largest debt market on Earth. The interconnections between Japanese monetary policy, U.S. rates, dollar strength, equity valuations, and global credit conditions aren't loose. They're tight. Tightly coupled systems don't absorb shocks gradually. They transmit them at speed. So now layer in the geopolitical dimension. The new prime minister is openly hawkish toward China, a government with nationalist instincts, a supermajority, and genuine security concerns will accelerate Japan's defense spending. That trajectory has already been rising for years. A government with this kind of mandate accelerates it. Defense spending is real spending, and the money has to come from somewhere. The most politically viable path is borrowing. More Japanese government bond issuance, which means the Bank of Japan, the dominant buyer of those bonds during the yield curve control era, faces a choice. Continue absorbing that issuance artificially, or step back as part of its ongoing normalization and let yields rise to wherever demand actually sets them. The Bank of Japan has been signaling normalization for months. The direction is clear, away from unlimited bond support, toward conventional monetary policy. That normalization, running simultaneously with aggressive new fiscal spending, is the combination that creates genuine structural stress. Not opinion. A mechanical consequence of two policy trajectories pulling in opposite directions at the same time. When the cost of Japan's money rises, when the yen carry trade becomes less attractive or actively dangerous, when Japan's foreign reserves become a funding tool rather than a passive holding, All of these forces point in the same direction: tighter global liquidity, less of the cheap Japanese capital that has quietly supported U.S. asset prices for years, more selling pressure on the exact treasury bonds the U.S. government needs foreign buyers to absorb. The pressure doesn't announce itself. That's the nature of structural stress. The pipes don't send a press release before they strain. You see it in yield movements that seem disproportionate to whatever the day's news happens to be. You see it in volatility spikes that come without an obvious domestic trigger. You see it in correlation breaks, moments when assets that historically move independently start moving together in ways that suggest forced selling rather than rational reallocation. You see it in the yen. When the yen strengthens sharply without a clear catalyst, it often means carry trade positions are being reduced, meaning U.S. assets are being sold to fund the yen repurchase. Watch the yen. Watch the 10-year Japanese government bond yield. Watch whether the Bank of Japan's normalization language tightens or softens in response to fiscal pressure from the new government. These are the signals that matter, not because they're academic, because they are the early warning system for the kind of liquidity shock that reaches U.S. portfolios through channels most investors don't see until the damage is already visible. Here's what makes this moment different from standard geopolitical risk. Most geopolitical risk is about things that might happen, trade wars that might escalate, conflicts that might spread, elections that might produce the wrong outcome. Those risks are real, but they're probabilistic. They may or may not materialize. The carry trade risk is structural. It doesn't require a crisis to activate. It doesn't require a policy mistake or a diplomatic breakdown. It requires only that the conditions which made the trade attractive stop being true. And those conditions, ultra-low Japanese rates, yen weakness, stable differentials between Japanese and U.S. yields, are already changing. Not hypothetically. Actually. The 10-year Japanese yield at levels not seen since 1999 is not a projection. It happened. The Bank of Japan's shift away from yield curve control is not a forecast. It's policy. The new government's fiscal agenda is not speculation. It was the platform she ran on and won decisively with. The structural shift is already in motion. The question the market is now pricing in real time is how fast it moves and how much it costs. For U.S. investors, the practical question is not whether this matters. It does. The practical question is where you're exposed and how much cushion you have between your current positioning and the point where this kind of liquidity pressure becomes visible in your account. The assets most vulnerable to this environment are identifiable. Anything that requires cheap ongoing financing to justify its current valuation. Highly leveraged companies with near-term debt refinancing, growth-oriented equities trading at multiples that assume rates remain friendly, real estate structures built on low-cost floating-rate debt. These are the positions that feel fine in a stable environment and become painful quickly when funding costs rise unexpectedly. They were priced for a world where Japan was the world's 0% friend indefinitely. That world is changing. There is a counterpart to the pressure. Higher Japanese rates could eventually stabilize the yen, attract capital back into domestic assets, and reduce carry trade volatility over time. Defense and industrial sectors tied to Japan's security spending could see sustained tailwinds. The story isn't uniformly negative. It's a reallocation. Capital moves. It doesn't disappear. But the reallocation itself is the event. And reallocations of this scale, involving trillions in foreign reserves, hundreds of billions in carry positions, a generational shift in Japanese monetary policy, are not smooth or orderly by nature. They happen in phases. Early movers position quietly. The broader market notices when yields or currencies start moving in ways that feel disconnected from any obvious domestic trigger. Then the explanations arrive, usually after the fact. That's not the optimal moment to be assembling a response. It's what the most sophisticated participants in these markets do, and have been doing since this election result came in, is not panic. It's prioritize signal over noise. They monitor Japanese yield direction. They watch yen strength as a proxy for carry trade activity. They look at whether U.S. Treasury auction demand remains robust or begins to show the kind of weakness that suggests foreign buyers are stepping back. And they assess their own portfolios not with the assumption that current conditions continue indefinitely, but with the honest question: if global liquidity tightens meaningfully over the next 6 to 18 months, where does my exposure hurt me? That's the question. not whether the world is ending, not whether Japan will crash global markets tomorrow. The more calibrated version, where is the friction, where is the exposure, and what level of preparedness do I actually have for an environment where cheap money stops being the default condition of the global system? Japan just reminded the market that the default condition is not permanent. The new prime minister has the political power to act on her agenda and will. The Bank of Japan is in the middle of a normalization cycle it has committed to publicly. The carry trade that has quietly supported U.S. asset prices for decades is under the most meaningful structural pressure it has faced in years. And the $1.4 trillion in Japanese foreign reserves sits at the intersection of domestic fiscal need and geopolitical decision-making in the hands of a government that has both the mandate and the motive to make consequential choices. None of this resolves quickly. These forces operate over months, not days. The pressure builds through channels most market participants don't monitor. And then, at some point, the accumulation of that pressure becomes visible. In yields, in currencies, in unexpected volatility, in correlation patterns that catch people off guard. The pipes are straining. They've been straining quietly for a while. What changed last week is that a new set of hands is now near the pressure valve, with a political mandate to act and no particular reason to defer to the comfort of global markets. That's not alarmism. That's the structure of the situation, read plainly. The only honest response to that structure is awareness, preparation, and the kind of calm that comes from having thought through the scenario before the scenario arrives. Liquidity, as the saying goes, is not owned, it's borrowed. And like everything that's borrowed, the terms can change without much warning and with no obligation to consult your preferences first. Japan just changed the terms. How far that change propagates is what the next several months will tell us.